Hi, Justin. Welcome.
Thank you very much. In terms of the emerging Europe macroeconomic outlook, for quite a while now, we have examined the risks going on in Europe and the potential of the recessionary outlook in Europe through the lens of capital, and that's really been the underlying factor that we've been examining. In Europe, the key problem really is a capital shortage and the need for capital and the drying up of capital for refinancing the external debt and current account deficits which have been built into the economic systems over the last 5 years. Now, I don't want to downplay the issue of external trade, because certainly a lot of emerging European economies, especially in Central Europe, are highly reliant on trade for their growth, especially trade with places like Germany and Italy, France and the UK. But it's the capital shortage in emerging Europe which is going to translate what could be just a traditional recession driven down by external demand destruction into a systemic crisis situation. And that's really why we at Business Monitor International are forecasting emerging Europe to underperform relative to other emerging regions throughout the world. Our aggregate regional growth forecast for emerging Europe is negative 2.6%, which is well below the next lowest emerging region, which is Latin America, which I believe is negative 0.3%. So essentially what has happened in Europe over the last 5 years is a very significant integration of capital markets, which has largely been facilitated by the expansion of the European Union and the Eurozone, and while provided a boon in terms of capital investments and also domestic consumption in the form of on-lending of foreign credit into domestic credit, this has also exposed the entire region's economy to the credit crunch which has began in the United States and obviously translated over into the Eurozone. And several months ago, what we did was we examined the risk variable within Europe through the lens of capital requirements, and we quickly saw several economies in the region which pose very high risks of systemic crises. And these economies were the Baltic countries, Ukraine, Russia, Hungary, Romania, and Bulgaria. And what has changed really in the last few months is that we've seen the transition, and our view has transitioned from this being a crisis scenario to being the core scenario. And as a result, our macroeconomic forecasts have reflected this. And we now forecast countries like Estonia and Latvia to contract by 9% in real GDP terms, countries like Ukraine contracting by 7.2%, and Russia and Turkey as well contracting by 4.0% and 3.3%. As our high-risk countries, which are facing very high external debt refinancing obligations and current account deficit financing obligations, as those high-risk countries push into the systemic crisis risk which we initially highlighted, this will pose cascade risks for the other parts of emerging Europe which had initially looked relatively better positioned. And these are the countries such as Poland, Slovak, and the Czech Republic. Poland, Slovak, and the Czech Republic did not have the very high external debt loads, the very high external asymmetries that we saw in the Baltics and Ukraine and Romania and Bulgaria, but nonetheless, the impact of the crisis scenarios playing out in those countries are starting to feed through into the outlooks and the systemic crisis risks within places like Poland, Czech Republic, and the foreign investor risk perception and the spike in risk aversion. And whenever we see a spike in risk aversion, as we're seeing right now in the markets, Poland, Czech Republic, Hungary, they get hit just as bad, if not worse, than the high-risk countries as well. So from a macroeconomic perspective, emerging Europe is very much in a position where they are on the precipice of a systemic financial crisis. And again, the question is how much will that feed through into the relatively safe or relatively better positioned economies such as Poland, Czech, and Hungary, and by extension, how will that feed on into Western Europe? Because once that feeds on into Western Europe, which has a very high exposure to emerging Europe debt, then obviously that suddenly poses a global problem as well. And we very much could see a scenario where another leg down in the global financial markets could emerge from an emerging markets crisis, which feeds through into Central Europe, which in turn feeds through into Western Europe. Now, from a financial markets perspective, we initially saw this play out in the equity markets most obviously. We saw the equity markets turn from their peak in January '08, which was several quarters before we saw the macroeconomic impacts play out. The equity markets played a very nice leading indicator. But we're also seeing very high concerns for pretty much every other asset class in the region. Currencies is probably the most obvious. We've seen the Polish zloty sell off by about 50% against the euro, and probably one of the greatest potentials in terms of playing a short EMFX position is with Czech koruna dollar cross, which looks like it has a lot further potential to go. It's moved down from 15 koruna per dollar to 23 per dollar, and we could very much see a scenario where that 23 goes all the way back down to 40 koruna per dollar. And as the currency effect plays out, the fiscal positions within these countries worsens considerably, and as a result, credit spreads rise well, and we're seeing CDS markets and local treasury yields as well spike considerably. So from an asset class or asset allocation perspective, there's very little in terms of the domestic assets within emerging Europe that looks very attractive right now.
Wow. Well, Justin, that's a hell of a presentation. Greg, do you have your sharp objects put away and everything?
Yes.